A legend has returned, and he's bringing 5 shocking insights that could reshape the game. In this video, we'll break down these revelations so you can learn, be prepared, and avoid the shock. But who is Michael Burry? For those who don't know him, Michael James Burry, an American investor and founder of Scion Capital in 2000, utilized a small inheritance to establish the hedge fund. Apart from being a physician specializing in neurology, Burry gained prominence among investors for accurately predicting the subprime mortgage crisis spanning from 2007 to 2010. His strategic move involved shorting the 2007 mortgage bond market through collateralized debt obligations, CDOs, resulting in personal gains of $100 million and $700 million for his investors. Following the crisis, he closed Scion Capital in 2008 to concentrate on personal investments. In 2011, he established Scion Asset Management, a private investment firm headquartered in Saratoga, California. Burry, portrayed by Christian Bale in the 2015 film The Big Short, is renowned for his insightful views on money and investing, often referred to as the Big Short investor. Beyond his successful short on the mortgage bond market, Burry continues to guide investors towards sound financial returns. Prediction 1. Another 2008-style financial crisis. In the first act of Burry's prophecy, the looming specter of a financial crisis reminiscent of 2008 unfolds. It's not just a generalized warning. Burry meticulously points to multiple potential triggers. Starting with the stock market, he observes an unsettling precariousness marked by overvaluation. This means that the prices of stocks might be higher than what their underlying fundamentals warrant, setting the stage for a significant market correction. The housing market comes under Burry's intense scrutiny, with his concern not limited to high property prices. He zeroes in on the substantial debt carried by many homeowners, a situation that could escalate should the housing market face a downturn. This debt could become a ticking time bomb, especially if homeowners find themselves unable to meet their mortgage obligations. Shifting to the banking system, a core element of economic stability, Burry paints a picture of vulnerability. Over-leveraging and undercapitalization are the culprits here. If banks have borrowed excessively or don't have enough capital to cover potential losses, it could lead to a domino effect, triggering a crisis. Essentially, Burry's warning is a holistic one, emphasizing that these interconnected vulnerabilities could precipitate a crisis reminiscent of the 2008 financial meltdown, urging us to be vigilant and prepared for potential economic turbulence. Prediction 2. Inflation. Becoming entrenched. In the second chapter of Burry's predictions, we delve into his deep-seated concerns about the entrenchment of inflation within the economic landscape. Burry's apprehensions are not merely about sporadic increases in prices. He envisions a persistent and escalating trend that could reshape the economic terrain. At the heart of this prediction is the concern that inflation is becoming deeply ingrained, not just a temporary fluctuation. Burry sees this as a result of various factors converging. Government monetary policies, including substantial money printing and expansive spending, take center stage. These policies, while aiming to stimulate economic activity, come with the side effect of injecting more money into the system, potentially driving up prices. The labor market is another piece of the puzzle. Burry is attentive to labor-related issues that could contribute to sustained inflation. If wages rise due to labor shortages or other factors, this can add to overall costs for businesses, leading to increased prices for goods and services. The upward trajectory of essential goods and commodities further fuels Burry's inflationary concerns. Whether it's the cost of raw materials, energy, or other fundamental components of the economy, if these prices continue to rise, they can have a cascading effect on the prices of end products, affecting consumers' purchasing power. Now, let's translate this into everyday terms. Burry's worry extends beyond economic theory to its tangible impact on people's lives. If prices keep rising persistently, the money you have today might not stretch as far tomorrow. This can erode the purchasing power of your income and savings, affecting your ability to afford goods and services. Burry is particularly concerned about those on fixed incomes, like salaries that aren't adjusting to keep up with the full impact of inflation. Before we dive into the next prediction, if you're enjoying the content so far, please take a moment to hit the like button and subscribe to our channel. Your support fuels us to keep bringing you valuable insights. Now, let's continue unraveling the intriguing predictions of Michael Burry. Prediction 3. Stock market to suffer. Another 2022 style leg downward. In the third installment, Burry turns his gaze towards the stock market, envisioning a downturn reminiscent of the challenges faced in 2022. His critique centers on the popular buy the dip strategy, a widespread approach where investors purchase assets during temporary declines with the expectation that they will rebound. Burry, however, challenges the fundamental assumption underpinning this strategy. His argument against the strategy lies in its reliance on the assumption that markets are always rational and efficient, and that declines in asset prices are merely temporary blips corrected by market forces. Burry contends that this assumption is flawed, especially in today's environment marked by increasing market volatility and uncertainty. Moreover, he sees risks in applying the buy the dip strategy during times of heightened market volatility. In such conditions, sudden and sharp market declines might catch investors off guard, leading to unfavorable exit scenarios. Burry's cautionary tale extends further as he characterizes this strategy not as a disciplined investment approach, but as a form of speculation. In essence, he advocates for a shift towards a more disciplined and value-based approach that prioritizes understanding the fundamental strengths of the companies or assets being invested in. Prediction 4. Banking system vulnerability. In the fourth act, Burry waves a red flag concerning the vulnerability of the banking system. Here, the focus is on the high levels of debt, interest rates, and leverage within the banking system. These elements, according to Burry, amplify risks and create systemic vulnerabilities, particularly in the event of a sharp economic downturn or a financial shock. Burry's concern is rooted in the potential for a wave of bank failures to trigger a crisis akin to the 2008 financial meltdown. He identifies key vulnerabilities such as the over-leveraging of banks, where borrowed money is used to increase the size of their investments. If these investments don't perform well, it could result in substantial losses that reverberate through the financial system. Additionally, Burry's warning touches on the potential consequences of high interest rates, as they increase the cost of borrowing for banks and can contribute to financial stress. Leverage, the use of borrowed funds to amplify returns, is also a double-edged sword, potentially magnifying losses during market downturns. In simpler terms, Burry is cautioning that the banking system, laden with these risks, could be susceptible to shocks that may trigger a crisis similar to the one witnessed in 2008. The intricate dance of debt, interest rates, and leverage makes the banking system a potential epicenter for economic tremors. Prediction 5. Alternative assets. Outperforming traditional investments. In the final prediction, Burry forecasts a paradigm shift in the investment landscape, with alternative assets outshining their traditional counterparts. This assertion is not a mere shot in the dark. It's grounded in Burry's long-standing advocacy for assets such as gold, precious metals, and farmland. His belief is rooted in the notion that these alternative assets act as a hedge against inflation and other economic risks. Burry doubles down on this stance by arguing that these alternative assets are poised to outperform traditional investments in the years to come. To understand why, let's delve into his reasoning. Burry sees disruptions looming in traditional financial markets, driven by the increasing dominance of passive investing strategies and the proliferation of complex financial instruments. These trends, in his view, create a market environment vulnerable to shocks and volatility. In this context, he positions alternative assets as offering a more secure and stable investment option for some investors. Moreover, Burry underlines the potential for technological disruption to further bolster the case for alternative assets. He points to the rapid adoption of blockchain technology and the transformative potential of cryptocurrencies as evidence of the changing financial landscape. In his analysis, these technological advancements contribute to the attractiveness of alternative assets. While acknowledging the risks associated with alternative assets, Burry contends that, for those willing to tolerate some degree of risk and volatility, they present a compelling investment opportunity in the face of an evolving financial landscape. In essence, Burry's final prediction urges investors to consider a diversified approach, incorporating alternative assets that may offer resilience in times of market turbulence. Thank you for joining us on this insightful journey through Michael Burry's predictions. If you found this information valuable, don't forget to give us a thumbs up, subscribe to our channel for more financial insights, and hit the notification bell to stay updated on our latest content. Your support means the world to us, and we look forward to having you with us in the future. Happy investing!